The money in your bank account doesn't really exist. That's not a metaphor, and it's not conspiracy talk. If every single customer walked into their bank tomorrow to withdraw their cash, the system would collapse within hours, because the money simply isn't there. This isn't a glitch in the system, it is the system. A design so old, so deeply embedded in global finance, that we've forgotten to question it. A design built on illusion and trust. It's called fractional banking, the quiet engine that powers global debt, inflation, and the illusion of wealth. And once you see how it works, you'll never look at money the same way again. To understand how this began, we have to go back, long before smartphones and digital payments, before banks and governments learned to monetize trust itself. Back to a time when money was something you could actually hold. In medieval Europe, wealth meant metal, gold and silver, coins that gleamed in torchlight, treasure you could bury, trade, or lock in a chest. But wealth carried risk. Thieves could steal it. Bandits could rob you on the road. And the more gold you had, the more dangerous it became to keep. So people turned to goldsmiths, craftsmen who worked with precious metals and kept secure vaults. A goldsmith's vault was safer than any home, and soon the wealthy began leaving their gold there for safekeeping. In return, they received a handwritten note, a receipt stating how much gold they'd deposited, and the promise that they could return at any time to collect it. Those notes were simple claims to real gold. But something curious began to happen. Instead of going to the goldsmith every time they wanted to pay someone, people started using the receipts themselves as money. After all, the paper represented the gold. Why carry heavy coins when a single slip of parchment could prove your wealth? This is where the magic began, and where the trick was born. Goldsmiths noticed something strange. Out of all their clients, almost no one came to withdraw their gold at the same time. If they held deposits for 100 people, maybe 2 would show up in a week. The rest of the gold just sat there, gathering dust in the vault. That observation changed history. The goldsmiths realized they could issue more receipts than the gold they actually possessed. If they had 1,000 gold coins, they could issue 2,000 receipts. Those extra receipts looked identical to the real ones, promises of gold that didn't exist. And because everyone trusted the goldsmith, no one suspected a thing. They began lending out those false receipts at interest. They were, in essence, lending gold that wasn't there, and earning profit from nothing. It was a breathtaking leap of imagination. Wealth created not from work, trade, or resources, but from belief. As long as everyone didn't rush to claim their gold at once, the illusion held. Money had been conjured from thin air. What started as a clever side business became the foundation of a new financial order. When people began accepting paper as equal to gold, money detached from physical reality. Banks were born from this practice, institutions that built entire empires on promises. By the 17th century, the game went official. Governments, drowning in war debts, realized they could play it too. The Bank of England, founded in 1694, wasn't created to protect depositors. It was built to fund the crown's endless wars. The bank lent the government vast sums, far more than it actually had, in exchange for interest. Those debts were repaid not with gold from foreign conquests, but with taxes from ordinary people. That cycle, governments borrowing imaginary money and repaying it with real labor, never ended. It evolved, multiplied, and globalized. Across the Atlantic, early American banks copied the same system. They issued notes redeemable in gold, promising customers they could withdraw any time. But like the goldsmiths before them, they quickly discovered that no one ever came all at once. So they printed more notes than they had gold to back. For a while, it worked beautifully. The economy grew, fortunes were made, and everyone trusted the paper. But every illusion meets its reckoning. When panic struck, when rumors spread that banks were overextended, people rushed to withdraw their money. Lines wrapped around city blocks. Panic turned to chaos as depositors demanded gold that didn't exist. Entire banks collapsed in days. The paper promises burned faster than ink could dry. And yet, instead of abolishing the system, governments did something else, something extraordinary. They institutionalized the illusion. They created central banks to act as the lender of last resort. The message was simple. Even if the money doesn't exist, we will make sure you believe it does. This was the true birth of modern finance. A world not built on metal or treasure, but on confidence. You deposit money into a bank. The bank keeps only a small fraction and lends the rest. That loan becomes another deposit elsewhere, which is then lent again. $100 can ripple through the economy as 1,000, even 10,000 new dollars, all of it existing mainly as numbers in ledgers. The system thrives because everyone believes the story, that their money is safe, that numbers in their account equal real wealth, that banks are stable. But those beliefs rest on air, on the same trust that goldsmiths once depended on to lend gold they didn't have. This is the invisible architecture of the modern world. Your paycheck, your savings, your mortgage, your government's debt, all built atop the same fragile principle, that promises are as good as gold, as long as no one demands to see the gold. Every crisis in history, from the bank panics of the 1800s to the Great Depression to the crash of 2008, has revealed the same truth. The system works until people stop believing. Once that confidence cracks, everything shatters. Yet every time the illusion breaks, those in power rebuild it. They call it reform. They print more money. They bail out the same institutions that created the problem. And each time, the world moves a little further away from reality. What began as a simple trick by medieval goldsmiths has become the foundation of our global financial order. The trick didn't disappear. It scaled. It became normalized. It became law. And today, it operates on a scale those goldsmiths could never have imagined. Because in the 21st century, most of the money in the world doesn't even exist as paper anymore. It exists as digits, pixels on screens, balances in databases, a global web of electronic promises, all built on the same ancient illusion. Money, once backed by gold, now exists because we believe it does. Because governments say it does. Because the system must continue. And that belief, fragile as glass, is what holds the modern world together. Imagine you walk into a bank and deposit $100. You think that money sits safely in a vault somewhere, waiting for you. You picture rows of cash neatly stacked in metal drawers, guarded by cameras and alarms. But that's not what happens. The moment you deposit your money, it stops being yours. It becomes part of the bank's balance sheet, a number they can use, move, and multiply. The bank is only required to keep a fraction of it, sometimes just a few cents on the dollar, as reserves. The rest, it gets loaned out, invested, and leveraged. That $100 becomes the foundation of a chain reaction that turns your single deposit into hundreds, even thousands, of dollars circulating through the economy. Here's how. You deposit $100. The bank keeps 10 and lends out 90. The borrower spends that 90, and the merchant who receives it deposits it into another bank. That bank keeps 9 and lends out 81. The cycle repeats again and again. By the time it ends, your original $100 has multiplied into nearly $1,000 of so-called money, numbers existing in multiple accounts at once. But only the first 10 ever existed as cash. The rest is debt. Every new dollar in that system is born as someone's promise to pay it back, with interest. This is the magic, and the danger, of fractional banking. It transforms debt into money. It builds prosperity on credit. And it convinces people that the numbers in their accounts represent real wealth. But here's the shocking part. That story is already outdated. In the United States today, banks are no longer required to hold even that small fraction of your deposit in reserve. Since March 2020, the Federal Reserve has set reserve requirements to 0. That means banks can lend as much as they want, limited only by internal regulations, risk assessments, and the willingness of borrowers to take on debt. If that sounds unbelievable, it's because we've been taught to think banks lend from deposits, that they need your money to create loans. But the truth is reversed. Banks don't lend from deposits. They create deposits through lending. When you take out a mortgage, the bank doesn't pull cash from a vault or transfer money from someone else's savings. It simply types numbers into your account. Money that didn't exist a second ago. Those digits become spendable cash, accepted everywhere, backed by nothing more than your signature and your promise to repay. That's how the majority of money in the modern economy comes into existence, not printed by central banks, but created by private banks through debt. More than 90% of the world's money supply is bank money, created through loans, not through savings. So what limits this power? If banks can conjure money out of thin air, What keeps them from lending infinitely? The leash is no longer reserve requirements. It is something called capital and liquidity rules, regulations established under a global framework known as Basel. After a series of devastating crises, most notably the 2008 financial meltdown, central bankers and regulators from around the world met in Basel, Switzerland, at the Bank for International Settlements, sometimes called the Central Bank of Central Banks. There, they designed a set of rules meant to ensure stability in a system that could otherwise create money without limit. Under Basel rules, a bank must prove it holds enough capital, real shareholder equity, to absorb potential losses from risky loans. For example, if a bank wants to make a $100 loan, it might need to hold $8 of its own money as a buffer. The riskier the loan, the more capital required. On top of that, banks must maintain a certain level of liquidity, assets they can quickly convert to cash, like government bonds, to survive a short-term crisis or a wave of withdrawals. These are the guardrails of the modern financial machine. They don't stop money creation, but they shape it, directing where and how fast credit can grow. Here's what that means in practice. When a bank issues a loan, it creates new money. Then, after the fact, it checks whether it has enough capital to justify that risk under Basel rules. The process is backward. Credit first, reserves later. This inversion changes everything. It means the engine of money creation is not deposits or savings. It's the willingness of banks to lend and the capacity of borrowers to go into debt. As long as someone wants to borrow, to buy a home, a car, or a business, the system keeps expanding. Every dollar borrowed becomes someone else's deposit. Every payment becomes another asset on a balance sheet. The economy hums, jobs are created, markets rise, but all of it rests on debt. When borrowing slows, the machine sputters. When people can't repay, the illusion cracks. And when confidence falls, the entire system trembles. This is why every major financial crisis is, at its core, a crisis of belief. When banks lose faith in borrowers, or when depositors lose faith in banks, the system freezes. The money that once felt solid suddenly evaporates, revealing what it truly was: numbers built on promises. The 2008 financial crisis made this painfully clear. For years, banks had created massive amounts of credit through mortgage lending, bundling risky home loans into complex financial products. When homeowners began defaulting, those promises unraveled. The illusion of safety collapsed. Banks stopped trusting each other. Lending froze. Global trade slowed to a crawl. And once again, governments and central banks stepped in, injecting trillions of dollars into the system, buying bad assets, cutting interest rates, and promising that the machine would keep running. They didn't fix the system. They reinforced it. They made the illusion bigger. Today, that illusion operates on a planetary scale. Across Europe, the United Kingdom, Canada, and Australia, reserve requirements have become symbolic. Sometimes zero, sometimes just a sliver of deposits. All rely on Basel rules to determine how much credit can exist. Meanwhile, in emerging economies like China, India, and Brazil, central banks still use traditional reserve requirements, often in double digits, to control lending. But even there, the Basel framework reigns. It dictates how risk is measured, how capital is calculated, how liquidity is managed. Every major economy now operates under the same architecture. A web of global regulations written in Basel, enforced by national central banks, and followed by every major financial institution. No one voted for these rules. They weren't passed by Congress or Parliament. They were designed by unelected technocrats meeting behind closed doors in Switzerland, and their decisions quietly shape how much money exists in the world. That's the paradox of modern money. It's not controlled by gold reserves or savings, but by equations. Formulas that measure risk, assign value, and determine who gets to borrow and who doesn't. You can feel it every day without realizing it. In rising house prices, in stock market booms fueled by cheap credit, in the invisible inflation that eats away at your paycheck. Because every dollar born in this system is a loan, and every loan must be repaid with interest. That means there will always be more debt than money. The system demands perpetual borrowing to survive. And if everyone stopped borrowing, if every household and business paid off their debts tomorrow, the entire economy would collapse overnight. The money supply itself would vanish because money is debt. That's the truth no one tells you. The system cannot function without you being in debt. Your mortgage, your credit card, your car loan. They aren't just your personal liabilities. They're the fuel that keeps the illusion alive. You are both the participant and the collateral, and the machine keeps running until confidence runs out. The modern banking system is a masterpiece of design, elegant in theory, dangerous in reality. It gives the illusion of endless growth, but beneath that illusion lies a set of consequences no one can escape. Every dollar borrowed, every credit extended, every interest payment made, all feed a cycle that quietly shapes your life, your country, and the future of the world economy. Three forces emerge from this design: inflation, perpetual debt, and the concentration of power. These are not side effects, they are built into the architecture. Let's start with inflation. We often think of inflation as prices going up: groceries, gas, rent, the things we buy. But inflation is not about prices. It's about value. When banks multiply the same dollars into new loans, the supply of money increases faster than the supply of goods. The value of each dollar drops. Inflation is not a mistake or a temporary flaw. It is the natural outcome of money creation by debt. As long as banks can issue loans freely, they create more money than the economy can anchor to real production. And when too many dollars chase the same amount of goods, prices must rise. That's why every year, even in stable economies, your money buys a little less. The system needs it to. Inflation ensures that money keeps moving, that debts are easier to repay in cheaper dollars, and that the illusion of prosperity continues. But it's also a silent tax, a hidden transfer of wealth from savers to borrowers, from workers to asset owners. The people who hold cash lose value. The people who hold assets, real estate, stocks, commodities, watch their wealth grow, because those assets rise with inflation. That's why inflation, though painful for the public, is quietly beneficial to governments and the wealthy. Governments, the biggest borrowers of all, can pay back yesterday's debt with tomorrow's cheaper money. And the rich, who own scarce assets, watch their portfolios balloon in nominal terms, even as the currency weakens. For ordinary people, though, it's a treadmill. Every year, your wages buy less. Every year, you must run faster just to stay in the same place. You work harder, but real wealth drifts further away. The second consequence is perpetual debt. Because money is created through loans, every dollar in existence represents someone's obligation to repay it, with interest. That interest doesn't come from nowhere. It has to be created as more debt. This means the total debt in the system must always exceed the total money supply. The math can never balance. Someone must always borrow more, or someone must default. This is why global debt never stops growing. Governments, corporations, and households are trapped in a cycle where the only way to avoid collapse is to keep borrowing. New debt pays off old debt. Old debt fuels new money, and as long as people believe in the system, it keeps expanding. The moment borrowing slows, the illusion flickers. Banks lend less, money creation slows, and economies begin to shrink. Recession follows. Governments then intervene with stimulus packages, low interest rates, and quantitative easing. Fancy words for printing new money and pushing more credit into the system. Each crisis brings the same response: more debt to fix the consequences of too much debt. And so the spiral continues, growing faster, larger, and more fragile. This leads to the third consequence: concentration of power. Fractional banking doesn't just create money. It creates leverage. Banks earn interest on money that doesn't exist. Governments borrow against the future, spending funds that haven't been created yet. And the wealthy, those who understand the system, position themselves where inflation works for them, not against them. If you own hard assets, inflation is your ally. If you live on wages, it is your enemy. Consider what happens when inflation rises. Prices go up. The cost of living increases. Wages struggle to keep pace, but asset prices, homes, land, stocks, climb even faster. Those who already own them grow richer without working a single extra hour. Meanwhile, renters, borrowers, and consumers feel the squeeze. They borrow more just to survive. And that borrowing feeds the same machine that keeps them trapped. This is not an accident. It's a feature of the system. It ensures that capital flows upward, that ownership concentrates, that those at the top of the pyramid benefit from the very instability that harms everyone else. Over time, this dynamic erodes the middle class. The gap between those who own and those who owe widens. And the system, which depends on endless growth, grows increasingly unstable. Every time the illusion shakes, every financial panic, every recession, every crash, the pattern repeats. Those who understand the game emerge stronger. Those who don't lose everything. Take the Great Depression. In the late 1920s, banks had extended credit far beyond their reserves, fueling a speculative bubble in stocks. When the bubble burst, panic spread. People rushed to withdraw their money, only to find that it didn't exist. Thousands of banks collapsed. Millions lost their savings. What followed was not a reformation of the system, but its reinforcement. The government stepped in, created new central banking tools, and reassured the public that deposits were now insured. Confidence returned, not because the structure changed, but because belief was restored. Fast forward to 2008. The same pattern, dressed in new clothes. Banks had multiplied credit through mortgage-backed securities, creating an enormous bubble in housing. When defaults spread, the system nearly imploded. But again, governments stepped in. Central banks created trillions of dollars in new money, quantitative easing, to bail out the same institutions that caused the collapse. The public paid the price through inflation and austerity, while the financial sector rebounded with record profits. This is the unspoken rule. When ordinary people lose, the system resets. When powerful institutions lose, the system bends to save them. And each bailout makes the next crisis bigger. That's because every rescue reinforces the illusion that debt can expand forever. That there's always another intervention, another stimulus, another print run of fresh money waiting to save the day. But the deeper truth is this: the system survives only because we keep believing in it. The value of your money depends entirely on trust. Trust in banks, in governments, in central bankers who promise stability while quietly inflating away your savings. Confidence is the oxygen of this system. When it's strong, everything feels solid. When it's gone, even the mightiest institutions crumble. That's why the world of money is built on symbols, not substance. Gold once anchored the system. Then, it was the dollar. Now it's the faith that digital digits in a database will always have value. But history shows what happens when that faith fades. Every empire that relied on credit to sustain itself, Rome, Spain, Britain, reached a point where the debt outweighed production, where inflation devoured the currency, and where confidence evaporated overnight. The pattern never changes. The only difference is scale. Today, the entire global economy runs on the same fragile faith that once held a medieval goldsmith's promise. And if that faith breaks, it won't be just a bank run. It will be a world run. Here's the uncomfortable truth. The modern world cannot function without debt. If every household, every business, and every government paid off what they owe tomorrow morning, the money supply itself would vanish. The economy would stop moving. Banks would have nothing to lend. Salaries would dry up. Stock markets would collapse. Because in this system, debt is not the problem. It is the product. Every loan creates new money. Every repayment destroys it. The global economy breathes in and out through the lungs of credit. And as long as you keep borrowing, the system keeps living. But if you stop, even for a moment, it begins to suffocate. That's why governments, central banks, and corporations are all desperate to keep the illusion alive. They need your participation. They need you to believe that the digits in your account are real, that your mortgage is manageable, that inflation is normal, that endless growth is possible. Your belief is the foundation. Your labor is the collateral. Your future is the guarantee. This isn't a conspiracy. It's design. When the Federal Reserve, the European Central Bank, or the Bank of England prints new money, they don't do it by firing up machines and pressing paper. They do it by creating digital reserves, entries and ledgers that flow into the banking system as loans, bonds, and assets. The moment that new credit touches the economy, prices begin to rise. And when prices rise, wages never catch up. The public runs faster just to survive, while those who hold assets watch their wealth inflate on autopilot. This cycle quietly transfers power upward. The rich don't just get richer, they become immune. Because they own the system's output, property, stocks, land, companies. They own the very things that benefit when money loses its value. You, on the other hand, hold its input. your time, your paycheck, your savings. These are the things that lose value as the illusion expands. And that's why the system doesn't want you to save cash. Cash loses value. The longer you hold it, the more it melts. The system needs you to spend, borrow, invest to keep the wheel spinning. A stagnant dollar is a threat. A dollar in motion is the bloodstream of the illusion. Now look at what happens when the machine hiccups. In 1929, credit expansion met its breaking point. When confidence cracked, the illusion shattered. People lined up outside banks, desperate to withdraw money that didn't exist. The Great Depression followed. In 2008, the same story repeated. Only this time, the illusion was wrapped in digital layers, mortgage-backed securities, derivatives, swaps. When homeowners couldn't pay their debts, the entire global financial structure trembled. The system nearly imploded under the weight of promises it couldn't keep. And what did the world's leaders do? They doubled down. They bailed out the trick. Trillions were printed. Interest rates were cut to zero. Banks were rescued. The illusion was restored, stronger and more fragile than ever before. Since then, every new crisis has been met with the same solution: create more money. When COVID hit in 2020, central banks around the world injected over $10 trillion into the system to stabilize markets. The result? The highest inflation in decades. The wealthiest individuals added trillions to their fortunes while everyday families faced soaring costs of living. It's the same old story, the goldsmiths trick, amplified to a global scale. And at the center of it all sits Basel, Switzerland, the quiet headquarters of the Bank for International Settlements. The place where unelected officials decide the invisible rules of global finance. These rules determine how much credit can exist, who gets access to it, and how far governments can stretch their borrowing before confidence falters. You won't see these meetings on the news. They don't need your vote, they just need your trust, and your silence. But trust is fragile, and silence never lasts forever. When people begin to understand that the money in their account is not truly theirs, that it is a promise that can vanish with a glitch, a bank run, or a policy change, something shifts. They start looking for alternatives. That's why we've seen the rise of digital currencies, cryptocurrencies, gold investing, and hard assets. People sense, even if they can't explain it, that the foundation beneath their financial lives is paper thin. They want something real. And yet, the system adapts. Central banks are now experimenting with central bank digital currencies. Government-backed tokens that could replace cash entirely. On the surface, they promise convenience and safety. But beneath that promise lies a new level of control. When money becomes pure code, it can be programmed, traced, frozen, or erased. Spending can be limited by category, time, or even social score. The illusion of wealth could become the illusion of freedom. This is where history whispers its warning. The goldsmiths of medieval Europe built their power by convincing people to trust a piece of paper over a piece of gold. Modern governments built theirs by convincing people to trust a number on a screen over a note in their hand. Each evolution of money has brought greater efficiency and greater dependency. Every financial empire that ever existed has fallen when confidence was lost. Rome's silver coins were diluted until they became worthless. France's revolutionary paper money, the assignats, collapsed into chaos. Germany's mark turned to dust after World War I. Each collapse began the same way, with too much debt and too little faith. And yet every time the same lesson is ignored. Money is not wealth. Real wealth is land, its resources, its skills, its knowledge, its independence. It's the things that hold value when promises break and systems reset. That's the real secret the financial elite have always known. When the system resets, and it always does, paper wealth burns, but real assets survive. So what does that mean for you? It means understanding the illusion doesn't make you powerless. It makes you free. Once you see how the game is played, you stop playing by its rules. You stop trusting the digits and start building the tangible. You invest in things that exist outside the cycle of inflation and debt. You value what you can touch, learn, grow, and control. Because in a world built on promises, the only true power is ownership. This is not about fear. It's about awareness. Knowing that your money, the same money you work for, save, and depend on, was never designed to make you free. It was designed to keep you moving, to keep you believing, to keep the illusion alive. But history shows that every illusion eventually meets reality. Every empire of credit meets its reckoning. Every promise stretched too far eventually snaps. And when it happens again, when the next crisis hits, when confidence breaks, when screens flicker and numbers vanish, those who understand will not panic. They will already have built something real. Because the truth about money is simple. It's only as real as the belief that sustains it. And belief is the easiest thing in the world to lose. So the next time you open your banking app and see those glowing numbers on the screen, remember, they are not wealth. They are promises. And the system behind them was never built with your freedom in mind. Understand the trick, and you begin to protect yourself from it. Ignore it, and you remain just another player in a game where the house always wins. If this gave you a new perspective, subscribe. Because history has the answers, and the next chapter is already being written.